Welcome back to Investing Talk Podcast.
Today we're looking at Navitas Semiconductor.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And this is a really unusual situation.
Right.
If you pull up the recent financials for Navitas, you'd probably think the company's just sinking. I mean, it looks bad on the surface.
It does?
But they're in the middle of this massive, and I mean deliberate transition.
Okay, deliberate. So the numbers we're seeing, this isn't an accident.
Not at all. We're seeing this sharp revenue contraction, right? Full year 2025 revenue is expected to fall something like 40% year over year.
40%.
And Q3 2025 was just, what, $10.1 million in revenue? That's down 53% from the year before.
Wow, 53% is just brutal. I mean, a headline number like that would send most investors running for the hills. So why are we calling this strategic? What are they getting rid of?
Well, they're deliberately phasing out their legacy business, the low-margin consumer stuff.
So like the fast chargers that come with your phone.
Exactly. Think 45-watt, 65-watt chargers. That was great for getting their name out there initially, but it's a low-profit, totally commoditized space now.
So they're just cutting it loose.
They're shedding it to free up every single resource. Cash, engineers, you name it, and they're going all in on these high-power markets.
And when you say high power, we're talking about the big ones. AI data centers, EVs.
And solar, energy infrastructure, all the high-growth areas.
That's the promised land for sure, but getting there must be costing them a fortune.
Oh, absolutely. The pivot means really high operating expenses, restructuring charges. They're still reporting pretty significant net losses.
How significant?
Trailing 12-month net income is sitting around a negative $125 million. Their net margin is something like negative 183%.
Whoa, okay, negative 183. That sounds insane, but I guess it tells a story.
It does. It tells you their small revenue base is just being overwhelmed by the huge amount they're spending on R&D to win these huge next-gen contracts.
So it's an investment phase. Pure and simple. This is not a stable business yet.
Not yet.
Okay, so that's the short-term pain. But this is where it gets really interesting, right? Because what all of these losses are masking is the counter-narrative, the pipeline.
The pipeline, exactly. Well, despite the revenue cratering, the company announced $450 million in design wins in 2024 alone.
$450 million.
That massive backlog, that is the single most important number for anyone bullish on this stock.
So investors aren't buying today's revenue, they're underwriting the future.
They're underwriting the conversion of that future stream. And we expect that big acceleration, the point where wins turn into real revenue, to start around Q3 2025 and then really ramp through 2026.
And that all comes down to their tech, right? Let's unpack the moat here. Why can't the old school silicon guys just catch up? Why is Navitas suddenly so critical for AI?
It's all about thermal and power management. That's becoming the bottleneck in every high-power application.
Okay.
The Navitas is a leader in advanced gallium nitride GaN and silicon carbide, or SiC. Think of traditional silicon like standard home plumbing. It works, but it has limits.
And GaN and silicon are, what, industrial-grade pipes?
Kind of. High-speed, high-pressure pipes. They handle way more current and get rid of heat much, much more efficiently than silicon ever could.
Which is why they're essential for AI and EVs.
Because of the power architectures. We're talking about 800-volt systems for these giant GPU clusters, the backbone of AI factories, and for the fastest EV chargers. GaN and silicon let you deliver massive power in way smaller, lighter packages.
Which is everything for density in a server rack or weight in a car.
It's non-negotiable.
So what's the actual IP here? Is it just better materials or is it something more?
They're enabling totally new designs. Their moat is proprietary IC design and being the first mover. For example, they were the world's first to have production-ready 650-volt bidirectional GaN ICs.
Okay, that's pretty technical. Break that down for me. What's the aha moment there?
The aha moment is that this one chip allows a paradigm shift from a clunky two-stage power design to a super efficient single-stage one.
So instead of two steps to manage the power, it's one smooth shortcut.
One shortcut. It means fewer parts, lower cost, much better reliability. It's a massive systemic win for their customers.
The biggest validation for all of this tech just came from Nvidia.
Yes. Navitas was selected as a power supplier for Nvidia's AI factory architecture.
Yeah.
That's not a small thing.
No, that's huge. Being designed into the foundation of next-gen AI servers, that gives them a really durable position, right?
It's a foundational win, for sure. Now, they are one supplier among others, but being chosen for this early architecture is critical. Power systems are designed in years in advance.
And once you're in.
It's incredibly difficult and expensive to switch you out. And we can actually see the quality of this new business in their financials. Even as the old revenue is shrinking, their non-GAAP gross margins have been totally stable,
Really? At what level?
hovering right between 38 and 38.5%.
That is a phenomenal sign. It means the new business they're adding is high-quality, high-margin stuff. They have pricing power.
It suggests their competitors just can't match what they're offering. It's the definition of a strategic move, shrinking for quality.
Okay, but a transformation like that, it just burns through cash. So let's talk about the balance sheet. Do they have the runway to actually see this through?
They do. The balance sheet is, it's robust, very strong liquidity. They have a quick ratio of about 7.1.
7.1. So for every dollar they owe right now, they have more than $7 in cash or assets they can sell immediately.
Exactly. And in a phase like this, that liquidity is basically oxygen. It keeps them safe.
And they have a decent cash buffer too, right? Around 75 million?
75.1 million as of March 2025, and they just fortified that recently.
With the capital raises.
Correct. The investment needed for this ramp was just so large, they went out and secured capital last year. In November 2025, they closed a private placement, raised $100 million from institutions.
At what price?
They issued about 14.8 million shares at $6.75 per share. And they also did an at-the-market offering earlier in the year.
Okay, so that is dilutive, which investors never love. It adds more shares to the pile. But in this case, it sounds like it was absolutely necessary.
It's necessary dilution. It funds the R&D, it funds market expansion, and critically, it funds the massive capacity ramp they need to actually service these huge AI and EV contracts.
So how much breathing room did all that capital buy them?
Based on their current burn rate, they have a pretty decent runway. At least 6 quarters, I'd say.
6 quarters.
Maybe more. Enough time that they don't need to do another capital raise in the immediate future. That time is just invaluable. It lets them execute without panicking.
So they have the time.
Yeah.
And they're building partnerships to de-risk the whole plan. That Global Foundries deal sounds like a big one.
It's a huge signal of confidence from a Tier 1 foundry. A long-term strategic partnership focused on U.S.-based GaN manufacturing.
And specifically for their new core markets.
Specifically for AI data centers and energy infrastructure.
The U.S.-based part of that is so important now. It de-risks their supply chain from all the geopolitical stuff.
And it guarantees capacity. It's a huge validation. But they didn't stop there. They're building out an entire ecosystem.
With who?
They set up a joint lab with GigaDevice for digital power solutions. And they inked a distribution deal with WT Microelectronics to expand their reach in Asia.
So they're positioning themselves not just as a chip seller, but as a core partner in the whole system.
That's the goal.
Okay, so for listeners focused on the next, say, 3 months, what are the immediate catalysts to watch for?
The big one is going to be the Q4 and full year 2025 earnings report. That's expected early 2026.
The moment of truth.
Pretty much. That's when we need to see some proof that the pivot is working. Investors are going to be watching for revenue to stabilize, or even better, start growing sequentially from these new AI and EV verticals.
And if the numbers show that conversion is starting?
The market will re-rate the stock very, very quickly.
And then there's the speculative side of things. I mean, the rumor mill is always churning with this stock.
Oh, absolutely. There's persistent chatter, unconfirmed, I should stress, about more big deals. Specifically, a supply agreement with another major cloud company besides Nvidia.
You can't invest on rumors, but that kind of talk does create momentum.
It does. And there's always the background speculation that they could be a takeover target.
Yeah.
You know, a bigger semiconductor player could just buy them to get that next-gen power tech instantly.
It saves years of R&D. That's interesting. It almost provides a sort of price floor. Now, shifting to the technicals. The stock has been on a wild ride this year.
Wildly volatile is the perfect way to put it. The stock's up something like 165% year-to-date in 2025.
All driven by the AI pivot and that Nvidia news.
Right. It's a classic momentum story.
Looking at the chart, the price is way above its 200-day moving average, which is around 74. So it's in a clear uptrend. For traders, what are the key levels?
I think the crucial support level is right around $7
Why 7?
because it's so close to that 675 institutional placement price. That's where the big money decided to get in, so they see that as a strategic floor.
Okay, and on the upside.
Resistance is at about 950 right now.
Yeah.
If it can clear that, that would signal the next major leg up.
And sentiment is, it's pretty split, which you'd expect.
Totally. Institutional ownership is growing, but the analyst consensus is still mixed. But the ones who are bullish or very bullish, Needham just raised their target from $8 all the way to $13.
Wow, that's a big jump.
It shows you the divergence. The analysts who really believe in the Gann and Seed story, they see exponential growth coming.
But that potential for big gains comes with a lot of risk. Let's talk about the beta. It's high, around 3.2.
Yeah, a beta 3-point narrow means it moves with the tech sector, but it overreacts. If the Nasdaq Q is up 1%, Navitas tends to be up over 3%.
And the reverse is also true.
The reverse is absolutely true. If the sector turns down, you have to be ready for some swift and large losses. Volatility is the price you pay here.
Which brings us right to the main risk, the bear case here. It's not the technology, is it? It's just execution.
100%. That $450 million pipeline is still just a pipeline. It's unproven revenue.
So if they fail to scale, or if customer ramps get delayed even a little bit.
Which happens all the time in this industry.
Right.
Then they'll burn cash faster than planned, and it'll put huge pressure on the stock.
Yeah.
The entire bull case hinges on them executing this pivot.
And if they don't, the financial risks come right back into play. High operating losses mean they might need to raise more capital, which means more dilution.
And that's before you even consider the market risk. The whole semiconductor industry is cyclical. It's exposed to supply chains, demand shifts.
And with that high beta, if the whole AI sector sneezes, Navitas is going to catch a serious cold.
You can't ignore that risk. It's a major factor.
So to sum it up, we have a company that is, strategically torching its current financials to try and win a leadership spot in the future. It's a classic short-term pain for long-term gain story.
That's it, exactly. I think you have to look at Navitas as a long-term play, 18 to 36 months out, to capture that structural growth in AI and electrification.
But there are also tactical opportunities for traders.
For sure, around these key catalysts like the Q4 earnings report. But ultimately, when you invest here, you are underwriting the execution of a technology leader. That's the bet.
It's a fascinating story, and the role that these advanced power chips are playing in data centers is one of the most exciting sort of under-the-radar trends out there. It's not just the GPU, it's about how you efficiently feed the GPU. We really encourage you to look more into the power density needs of hyperscale AI. It is truly mind-blowing stuff.
And of course, if you found this analysis helpful, please do hit that subscribe button to catch our next one.
See you next time.